Apple has been hit, but my next guest has some ideas that could pay off in the long run. Let's bring in Brook Dane. He's portfolio manager at Goldman Sachs Asset Management. Brook, welcome. You know, it takes a strong stomach, I guess, to be steering the ship right now. So where do you think are the best opportunities?
Yeah, hi, Kelly. Thanks for having me on. You know, it's been about the most complicated tech investing environment that I can remember over the past 20 years. And it's a really important time to be out talking with clients and investors about where we do see opportunities. So, you know, when we step back and look at the opportunity set around us, we are still big believers in, you know, the long-term transformational impacts of much of the tech ecosystem. So if you think about, you know, in broad brush, what's happening in software and digital transformation, what's happening in semiconductors with renationalization and semi-cap equipment, we think there's tremendous opportunities in there. Now, I will say, we don't have an edge in calling the macro, and clearly the economy has slowed and has slowed pretty dramatically out there. So as always, we're encouraging investors to have a balanced view and to be thinking about risk rewards. You know, we're big believers in focusing on valuations and free cash flows, as well as investing in these disruptive companies that we think have huge opportunities. So we are seeing a lot of opportunities, you know, in software specifically, just to talk for a minute. You know, I think there's a belief out there that software is going to do relatively better in a tougher environment because we do feel like companies are investing in digital transformation. We actually got a proof point of that earlier this week, where I don't know if you caught it, but when Bath and Body Works reported, you know, they're a retailer that's going through some difficult times with the impacts of inflation and labor and all those kind of things. What they talked about in their call, though, is they're actually accelerating their investment in technology to capture the opportunity. So they're taking their tech spend up from 75 million to 100 million this year, because they view the imperative of making this digital transformation happen. That's the kind of proof point that gives us comfort out there. So.
Absolutely, and exactly the kind of thing you'd be listening for. One more kind of big picture question on this, though. Do you think that this will prevent tech stocks, let's say software, whatever you're going to say, from falling into a post-2001 kind of slump, a post-financial crisis kind of slump? I mean, the kind of thing where people get thrown out of the room for even mentioning tech, you know, investment ideas.
Yeah, I don't think so. And, you know, there's a couple of reasons behind that. But fundamentally, these businesses are incredibly solid. And, you know, I'm sure we'll talk in a minute about companies like Microsoft or HubSpot or Dynatrace, where like their businesses are actually performing at very high levels, you know, and we expect them to continue to. And, you know, now the stocks, you know, basically you've had this environment where all the tech stocks have sold off in almost lockstep based on their growth rates. We think that creates an incredible opportunity for differentiation amongst the winners and the losers, and for the ability to, you know, to identify those companies that you think can compound out their cash flows at high rates over time. But there is going to be winners and losers across this environment, and it's just really important to hone in on where you think you have insight and where things are being differentiated out there.
Shepard Smith here. Thanks for watching CNBC on YouTube.